courtesy of Capital Discussions, we're on WebEx again. And no, I know it won't be in this room. It's something we could work. Somebody's saying there's no volume in this room, and that's true. And it's something we work on for the future. But for the time being, we're making sure it gets on the recording. And if there's anyone who's connected in. Tom Clark is going to talk on his experience trading the bull, which is a trade by John Locke. And so maybe we can have a nice hand for Tom Clark.
Maybe I can just do this here. Okay, is that good enough? Like that? Okay, good. Yeah, I'm Tom Clark. I've been coming here about 2 years now, and I've gotten a lot of really good information out of this group, and this is one of them because mainly it got me connected up with Capital Discussions, which seems to be a fantastic site for information. Go ahead. Everybody starts these things out with a disclaimer. I don't have one. But I just want to say up front, I'm not professional. I have no financial education or background. I learned by the School of Hard Knocks. What I present tonight, I think is correct. I think I understand it enough to explain it, but the burden's on you to believe it or not. In other words, don't take this as gospel. If something doesn't sound right, doesn't look right, go home, figure it out, call me, because I could be wrong. And I'd hate for anybody to lose any money on my account. Okay. I found this on the John Locke website. I heard him mentioned on Capital Discussions. Went out to his website, poked around. Seemed like a pretty straightforward website. He's got a good reputation. I looked at some of his free videos, and I found this one trade that for some reason just stuck out to me and says, that's what I've been looking for. Next screen. You can, I think Don put a couple links on the website for some videos. If you go to YouTube and just type John Locke bull trade, there's several there to choose from. Suggest these two they're very similar, but he says something a little different in each one of them, and takes the two combined to get the full picture, I think. Okay. It turns out I found this, I'm going to say 18 months ago, and it was on one of his free videos. He says, I'm just going to throw this out here for everybody. Since then, he's put together what he calls a super simple spreads program, and it's a course you buy, and the bull is one out of 4 of the strategies on there. He's charging $9.75 for it, so tonight's worth, I figure, $2.50 to you. I'm tempted to go ahead and pay him the $9.75 to get the other 3 because this one's so good, and I'll explain why I'm tempted later. Next screen. The part of his demonstration introducing this spread, he put up a little screen of BACKTEST, and it's for like 13 years, from 2002 to 2014. And he had 2 losing years, 61.6% one year, 45. That just looks too good to be true. The 2 years were kind of rough, but then compared with what the S&P did, and I've always my benchmark has always been the S&P. If I can do as good or better than the S&P, I count myself good for the year. And this answers the bill. But you average all that up, and it's 23.2% average return a year. I like that. And I said, if I can get half of that, I'll be a happy camper. So I started digging into it. He mentions this in his video. The reason this just stuck out to me as the trade I wanted is it's totally rule-based. Okay? No technical analysis. You're not trying to pick a stock. 0 adjustments. I mean, how simple is this? Check it once a day. I think John Locke checked it like a half hour before the close. I'm a little more watchful than that. I kind of watch it 2 or 3 times a day, but I can certainly attest to the fact that you could watch this once a day. You could check it after the market closed and probably do all right. You put on in one position a month. It stays on for a month. You take it off and replace it for the next month. Totally non-discretionary, no decisions to make. There's no question about what strikes to use, how to place the order. It's all in the rules. Go ahead. And here are the rules. This is it. You use the underlying rate, which is the index. Your entry point is 65 days till expiration. 65 days to expiration of the options. Works out really nice. It's always a Tuesday. And Tuesday is a great day for me. I don't do anything else on Tuesdays. And it's a put credit spread, a vertical. You put the short. He says at delta 10, and you go down 30 points, put the long on. But then he tells you in the video, that's just a starting point. What you want to do is you want to move that strike up and down until you can get 250 credit. Okay? So once you find the combination of the long and the short that gives you 250 credit, you just, enter that trade. It's somewhere, say, 30-point wide. So it takes $3,000 to put aside to cover this trade. And you'll take in $250 credit, or maybe a little more. You hold it until it loses $250. It'll happen 2 or 3 times a year. In other words, you got paid $250 to put this on. You want it to go to 0, and it expires, and you got $250 to keep. Worst case, if the market goes against you, that $250 gets bigger, and you got to eventually buy this back before it gets out of hand. So basically, you put a stop loss at $5. If that spread ever gets to be $5, it's time to get out and lick your wounds. It's happened to me twice. The maximum gain you can get is the $250 that you took in as credit. Now, you'll never really get that because we don't hold this till expiration. Yeah, there you are. You exit this, besides the stop loss, you exit when the next trade's available. Okay, so when the next strike is 65 days to expiration, you close this one out and buy the new one, or sell the new one. So your at risk is basically $2,750, assuming you got the $250 for the credit. Okay, that's the $3,000 spread minus the $2,500 you got up front. Any questions? Yes. Just monthly. You can do the weeklies, though. I'll touch on that in just a minute. Any more? Okay. Yeah, yes. Do you ever layer the trade, like in 15 days? No. Once I know the rules, I'm loath to break them. John Locke said this is the way the trade works. That's the way he back-tested it. I proved to myself he's correct. I'm not going to mess with it. On his back-testing, did he only do one trade a month? Yes. And on that note, I believe he said he used end-of-day data. Okay. And we'll talk more about the back-test. Yeah, we'll put it out. During the length of the trade. In other words, you're going to be on this trade for roughly 4 or 5 weeks. So at any time during that period, when your loss gets to be $250, you just get out. Okay, so that's the maximum loss. Because if you hold this thing, you could lose the whole $3,000, well, $2,750, and we don't want that to happen. Okay, next slide. I'm going to take a step out of this for just a minute, and for those, does everybody here understand credit spreads, or should I go through it just a little bit? Okay. Basically, this is a graph from Thinkorswim, and it's of a credit spread put on. The zero line here, well, let me just start here. Here's your max profit line. Along here's the price of RUT. Okay. Our short put in this example is $13.50 on the Russell. We got $12.50 for that. So that's $1,250 went into our pocket when we sold that put. We bought a put down here, 30 strikes lower, 40 strikes lower in this case, for $8. We paid that out. So the difference between that's what goes in your pocket, $4.50 or $450. That's this gap in here between the zero line and the max profit. This green line is what the trade will look like, profit and loss, at expiration, 65 days into the future. This blue line is today. Here's where we sit at $14.55. That's where we were when we put this trade on. We're sitting on the zero line. We've either made money or lost money. We're even. Now, if the market increases, you move to the right and you call up this line. This is your profit. The further the market goes up, the more you make. If the market goes down, you're below zero, you're losing money. Okay? As time goes on, this blue line morphs to the green. That's your theta or time decay. So this will keep creeping up. So even if the market doesn't move, as this line goes up, we'll be making a little bit of money. Okay? The danger is out here. Okay? That's why we bought this protection. We can only lose, in this example, a little over $3,500. But we put a stop loss in at some point where we're only losing a fixed amount, the $250. Okay, we can go on now. John Locke put this trade on using no right now. In one of his slides, or one of his videos, he mentions it's okay to do it with other things. You could do it with SPX. You could do it with SPY. I like the RUT, personally, mainly because I don't know how to do it, but if I was to examine my overall portfolio that I manage and figured out what its correlation was to the S&P 500, it's probably close to 100. So anytime I get a chance to do something that's a little different from the S&P 500, I like that. That's a plus. It's generally smaller cap. Because of that, it's more domestic versus foreign than the S&P. You've got less exposure to foreign markets, currency exchange rates, whatnot. It's high priced. It's up around 1,400 right now. You want a high price underlying because that gets your premiums up. Just being an index is an advantage. You don't have to worry about corporate actions, earnings reports, mergers, all this stuff. It's just the index. Surprisingly enough, the volatility on the Russell is quite a bit different than the S&P. I would have thought they'd have been closer, but they're not. In fact, if you plot the RVX, which is the volatility of the Russell, against the VIX, I was surprised at how much difference they were. Highly liquid and not a crowded trade. Now, what do I mean by that? Years ago, I joined a service that sent out a weekly credit spread on SPX. And it was a popular, I gave it up because it was just too much to keep track with, but it was pretty popular. They must have had thousands of customers because I could see it at 9:30 or 10 o'clock on Monday morning when that alert come out. I could go on Thinkorswim and just see the orders pop up. You know, I could watch the order flow, and as you see those same spreads popping up, there was thousands of people making that trade all at the same time. When I first put the RUT on, the bull spread. I did the same thing. I went and looked at the orders on Thinkorswim. There wasn't another one out there. I looked at the volume that day and compared it with the open interest the day before. I didn't see a single other person make that trade than myself. I will say I checked last month, and I think I see some activity out there. It's kind of hard to pinpoint because it's up a strike, down a strike, not all hitting at the exact same minute when the alert came out. So I think there's probably some company out there, but my experience with that weekly is I don't care how many thousand people you try to make in that trade, the market can handle it. You know, it's liquid enough that it doesn't matter. So but I thought it was kind of interesting that I was the only one. I actually saw my order go through and get executed, and I saw the volume click up my 10 or my 10 contracts. So it's not crowded and highly liquid, okay? I put together this little table in Excel. It's kind of awkward to say, okay, you put this trade on, you start the 10 delta, you go up till you find the right credit, the right credit. So I built this guy, and I just put in a target strike, put it right here, and it tells me what the mark is. Okay, and I've got 5 up and 5 down. So this is where I started out for this month's trade. The strike I just happened to pick gave me a credit of $1.85. Target's $2.50. So I move up. The next strike is $2.10. Next strike $2.55. Bingo. That's the one I want. Okay. I'm not going to settle for less than $2.50. I can probably get it with a $2.55 strike. I'd never been more than 10 cents off. I've hit the mark. I would not be if this was $2.45, or say $2.50 exactly, and I was worried about getting it. This was $2.75. I hate to go above $2.70. The further up in strike you go, the more premium you get, but the closer you are to the danger zone. In other words, your risk goes up. So don't reach out here for extra yield. You know, I think the furthest I've been was 272 or 274 as far as I've been up. I get nervous. I just don't want to go to 280. Probably couldn't get away with it, but why take the risk? So you find the strike you want. In this case, it'd be the 1280. I put that in here. It shifts everything down to where the one I want's highlighted in green, and then it prints out the Thinkorswim trade down there. I'll show you in a few minutes. The very first trade I put on with this, I totally butchered in execution. It's very easy to make a mistake. So I do have the Thinkorswim. You Control-C that, go to Thinkorswim, click on the magic button, and the trade's entered. You know, what can be simpler? And you get the option of changing the strike once you get into the platform. Any questions? Okay. That's correct. Theoretically, right. But we have that stop loss in at 250. Yeah, we have a stop loss. When we put this trade on, we're only going to accept 250 loss. So it gets to that point, we get out. Exactly. I mean, it's not perfect. Putting the stop loss on at 250 does not guarantee you that's max loss. You could have a gap down. I mean, but my feeling is that potential exists for whatever trade I'm in whatever market. And it's, you know, cost of doing business. Hopefully it doesn't totally kill you when it occurs. Go ahead.
So, just to be clear, you're putting in a regular stop loss?
No.
What kind of order?
Okay. First off, I got to fess up. I don't trade this on Thinkorswim because all my money is in Fidelity. They have a terrible trading platform. I'm leaving them as soon as I work through all the free trades they gave me to stay. And I don't know how many they were, but I'm still burning them. I have done similar to this on Thinkorswim. What you have to do is put in a contingent order on the mark. So you say, if the mark gets to be, we put this on for 250. So our stop would be 5. So you put an order in and says, if the mark of this spread gets to be 5, I want out.
So you're going to go at the market.
Yeah, that's my thinking.
Well, that's understandable.
Yeah.
Because you know you're going to get
I
out.
want out. I don't care what the cost.
Yeah. Okay.
Yeah.
I've found put in a stop loss order like
Yeah.
on the mark. Sometimes they'll open up. You'll have a bid side and an ask side. So it's kind of have a wrap. You'll get hit on your stop. It turns out you really don't want to get.
Well, yeah. I mean I know, and again, I've heard of that. It's never happened to me. I don't doubt it will. And if it happens to me, it's kind of price you pay for the security of having that stop loss in place. Now, I personally, since I'm on Fidelity, don't use a stop loss. I watch it. Okay. Now, you could put a contingent order in to say, if it hits 250, I want out, but put a limit on it. And that would protect you somewhat from that. Exactly. No technical analysis. You know, I put this trade on the second Tuesday of the month. Whenever that 65 days to expiration is, I put the trade on regardless of what's happening. Okay, there's no technical analysis, no market analysis. You just do it. Did that answer your question? Okay. Next slide. I also, since I'm trading on Fidelity and they have such a lousy platform, I've got a second spot in my spreadsheet where I actually track the trade. You know, I love Thinkorswim because it imports the quotes automatically. So I just got kind of this tool. And this is where I don't look at the chart. I don't look at the risk graph. I look at this. Right there's my P&L. Okay, now this is a 10 lot. So that would go to 2,500 would be the max. Right now I'm sitting at 645. This trade is, well, I also have over here days remaining. That's not till expiration. That's to when I get out of this trade. So this trade's only a week old. Okay, and I'm up $650 on a 10 lot. So that's how I monitor the trade. Next. I do. I'll show that in a few minutes. Yes. Yeah, it's 65 days to expiration, but this is the days I don't hold till expiration. So this tells me how many more days left I got to hold, and then I'm out, and I do the next one. Okay. Okay. This is the most recent trade I put on, and it's kind of like that previous graph, but this is a real one. This is a 10 lot. Somewhere it says that, down here. Okay, it's the 1220 short, 1190 long. My max gain I can get is 2,500. Max loss is kind of off here, but it's 2,500. Okay, Here's where I said I just put the trade on. Now, I like to take a second price slice and slide it over here to where my 250 is, my stop loss. In this case, it's 2,500 because I got a 10 lot on. So this tells me if the market gets to there, I get out. Okay, it also shows that one standard deviation is a little bit beyond that, which that may be that's a problem. Next slide. But if you change the date from expiration to when you close this trade, in other words, that previous graph showed one standard deviation till expiration, 2 months out. This shows the one standard deviation for the period that I'm actually going to hold it. Now, it's pretty close to where that stop loss is. I don't know if that's coincidental or not, but it shows by just getting out early, we've increased our probability of winning a little bit. I won't try to put a number on it. Next slide. This time, I moved my date down here to the date that I closed this trade. And this shows what the trade would look like if held till that 28th day, and it's time to get out. Okay? If the market didn't move at all, where's my profit and loss? Right here, $1,500 with no market move at all. That's all theta. But you can see that if the market moves up, I make more. I will never get that full amount because you don't get that till expiration, but I can get pretty close. My stop loss has moved further out in price yet, because as this blue line moves up, the stop loss point moves out, so you're constantly getting a little extra room down there as time goes along. All this I think of as little, I think one of the guys in capital discussion says edges. Just the little things inside this trade that improve your odds. Next slide. Yeah, I'm just pointing out here how far down the stop loss is now. Yes.
So one of the things that I've been looking at recently is talking about full put spread. So we're talking about on the put, keep your expiration date short. In other words, what it was advocating was you pick something, say 100 points out, you buy it 35 days before expiration, you hold it to expiration. And this seems like it's the same type of thing, only you're back 30 days.
Yeah, exactly, and getting out early.
Comments on that, pros and cons, do you advantage one over the other?
I've come to appreciate it the way it is, but I'm not sure. I can show you something in a minute. But again, I'm going to go back to I'm the guy that follows the rules. And once John Locke told me the rules, and I got faith in them, I'm not going to break them because it works. If you're down towards the bottom down there, yes. Yeah. And, think of this, you might know a way of looking at it, is the max you can get when you hold this is $250. Well, if after a month you've got $190, do you want to hang around for $60 more or put a new trade on? And I think, I'm going to say that I'm not a big fan of Thinkorswim and all those guys, but they've got a policy out there that on their spreads, they hold for 50% and get out. And they've run studies and said that works. I won't refute it. But, yeah, it's the rule. Okay. I want to think of Thinkorswim and Tasty Trade. I don't watch their show a whole lot, but I do get an alert at the end of each day or the beginning of the next day that tells me the highlights of things I might be interested in yesterday's shows. And I read them, and occasionally I find something. And I found this just coincidentally a few days ago. And they were trying to justify their policy of taking winners at 50%. And the one thing that two observations about the stock market is that long term there's a positive drift. All right. And the longer you hold on to something, the greater probability of something ugly happening. Okay, next slide. Now this is what caught my eye. They did a distribution of monthly gains or losses on the SPY. And you can see the center of the curve is above zero. So that's the argument that if nothing else happens, you can depend upon a certain bias to the up. So you've got that little bit working for you all the time. They also said, and this is the part that really caught my interest, stock market has tended to have more outlier moves on a monthly basis than on a weekly or daily. Okay, and that's this guy out here. That's the one that can kill you, or at least cause pain. I assume that if a monthly is worse than a weekly or a daily, a 2-monthly is worse than a monthly. So we put a 2-month on and get out in a month. So there's a little bit of risk reduction there. I really want to go back sometime when I got the time and do this chart for the rut. But that's probably not going to happen. Okay, here's my trading results. Now, I started this January of last year. And right off the bat, the very first one, I put on the 13th of January. On the 9th of February, I got stopped out. I hit that stop. You'll notice my loss. This is a 2-lot I had on. I'm just starting out small. Was $618. It should have been just $500, right? Because I said 250 is the max. Well, here's where I'm talking about it can get complicated if you're not used to this stuff. I put the trade on in Fidelity, but I was modeling it in Thinkorswim. And at the last minute, the market moved before I put the trade on, and the strike shifted up. So I bought that, or sold that. But I didn't change my simulation in Thinkorswim. So when I was monitoring Thinkorswim, and all of a sudden I realized I got a $250 loss, I was at $350. Okay. And I spent several hours trying to figure out which one's right. Fortunately, during that time, the market came back a little bit. So I got out for $309 a lot. That's when I went to work on that string to build the trade for me. Of course, until I get to Thinkorswim, it's not going to help me. But the point is, fill out your order, check it twice. It's simple, but you can still make mistakes. But the next month, I did all right. $417. Still 2 lots. Over here, I've got the single lot calculated. That's $206.84. This is with commissions built in. So I had, $208.84. That's pretty good on a 250 max. I ran it again. This time I got, I think that's 183. Next month, 155. Next month's 150. Here are the percent returns. I was ready to find a tree.
I thought this was the bull.
No, that's not the bull. Where was I? Okay, yeah, these are the percent returns. Now, the way I calculate return is whatever I end up profit divided by the maximum I have at risk. In this case, it's $3,000 minus the premium I received up front. So if I got $250, my risk is $2,750. We all agree with that one? Okay. I've seen fights on the internet chat rooms over how to do that. Some people say you can't subtract that premium out. But anyway, 5% a month's not bad. Now the blue ones are, I decided to experiment with weeklies in between. I was starting to get it down to pat, and I was getting bored. Okay. So I said, I'll throw some weeklies in here. And they work just fine. Okay. There's one weekly that's right smack dab between the two that works perfect. And I couldn't really tell any difference. But after doing 3 months of them, I said, that's a little more excitement than I really want. You know, I put this trade on because it was simple. And I probably went a week making the argument in my head, you know, really diversifying by splitting the trade into 2 pieces and doing a monthly and a weekly. I don't know if there's any advantage to that or not. There's a little diversity on entry time, but that's about it. It's still the same underlying, still the same strategy. So after 3 months of it, I decided not to. I did have one minor loss of $130 on one of them. But I don't blame that on it being a weekly.
Is that because your rule says coming out?
Exactly. When the magic date come to get out, I had to be at a loss. Okay. That happened once. I did get stopped out down here with a hard stop back in, I think it may have been our election. No, I don't know when that was. That was, yeah, all right, well, whatever. One other thing I said I can spot it. I think it's this one. I put this trade on the 27th. This column here is when you put the trade on, when you put the trade off. That's known into the future. It's based on the calendar, based when you're 65 days from expiration. So I have an Excel spreadsheet, and that's populated all the way down. Okay? And I know that on that day, I buy to close and sell to open the next one. You can see right here. On the 13th, I bought to close, sold to open, same day. So from that price to the left is all pre-planned. Now, the trade date should be the same as the date that I'm opening the next trade. Sometimes it's not. If you have a stop loss. Okay. There's one other case, and I'm not sure I can find it. I was, I think, 10 days before the magic get out date, and I was at 220 profit. Do I want to hang around for another 2 weeks to get part of that $30 that's left? And I can't get it all, I know. And I decided I did break the one time I broke the rule, I got out early. I didn't see any sense in hanging around for that last $15 or $20 if I was lucky. So I just got out and I waited until the proper time to get back in. To my knowledge, that's the only time I knowingly broke the rule. And I'd do that one again. End of the year, I'm into my second trade this year. Next. I don't have it on here. Next slide. I took just the 12 trades that made up last year. I took out the 3 weeklies. Okay. And I took out the 2 trades I made this year. This are the 12 trades I made last year. And I've normalized it to a single contract. And bottom line is I made $1,108. 40.5%. I remember back on John Locke's trade, he said the average was 20, and I said I'd love to have 10. So you can imagine I was a pretty happy camper.
Was that based on your initial balance, or was that based on that's the money?
Well, honestly, I did it both ways. This I just totaled up the monthly percentages because they're all the same size anyway, same at risk. But I also took the beginning and the end, and I came out within 0.1%. Okay, so it's a good question. I think I'll go back to what I said earlier, though. If you see something that doesn't look right, don't trust it. But that's, to me, what I think I booked, yes. Pardon? I'm sorry, I didn't hear you. $3,000 minus $250 is $2,750 per lot. Okay. Now back up one slide. you'll see that I started out with 2 lots. So that's 6,000 minus 500, which is $5,500 at risk. After 4 months, the mechanics was down pat. I didn't see anything that scared me. So I upped it to 3 contracts. Then I went to weeklies with 3. And I did 3 on down until I finally went to 6 to 8. And now I'm trading 10. So 10 would be 30,000 minus 2,500. 2,750 is your risk. Any other questions? Yes?
How are you changing your contract just based on your feel of your comfort level, or do you have a money management scheme?
I have a money management scheme that I'll touch on in a few minutes. But initially, I just wanted to start out small, grow it to somewhere in where I think I might want to end up. At this point, I have to admit, I was pleased with the results. I was tired of just getting 6 or 8. I wanted 10. You know. Mike's been trading this with me. Have you got anything to add, or?
Not much. I just would say on the previous slide, there's the reds and blacks. Everybody probably understands that the reds are the negatives, and the blacks are the positives.
Yeah, that's what I took in. That's what, let's see, P&L. Yeah, that's a minus.
But the pair of them results in the profit.
Right. Yeah, this column, for example, I sold to opens. I started the contract, took in $536 credit. When I closed out, it cost me $169 to get out of the trade. So that difference is my profit. That's a good point to bring up.
Well, I appreciate what Tom has done in terms of education within the team. It's awesome.
Thank you. Yeah, it's real. It's my dollars in there. I'll tell you, I sweat blood and tears. Go to the next screen. Yeah. Now, I have to say, last year was a good year for everybody. You know, the Russell was up 36%, I think that is. So, you know, I still beat the index. But the reason that's 40 is because this is 38. The S&P did 20. So, seeing as I'd like to judge against that, I doubled the S&P.
Wait a minute. That raises the question. Suppose the rut had not been up 36%.
I wouldn't have made 40, I'm sure.
What might you have made? 5, 10? Do we have a way of getting at that?
Yeah, I don't know that you know. I mean, when you look at this number, that's January 1 to December 31, straight line. What you finally end up getting is going to be all this up and downs in between. So this is just a good, strong upward bias. So you've got a strong possibility of good result. I don't think you can go much further than that. Now, it's not all, yes?
You got 40. Did John Locke, and maybe he didn't. If you were to do the same traits, I know you shared it earlier, you think
Yeah, I actually, having gone through a year and going back and reviewing his back test makes sense to me. You know, and I think Don may speak a little bit to that more in the second half tonight because he's done some back testing. But I didn't see anything in my results that contradicted what John Locke had in his back test. Certainly don't expect him to, you know, match up perfectly, but he probably didn't have in his back test a year where the Russell did 40, so I couldn't compare. But generally speaking, after a year of this, I have reasonable level of confidence with his back test. No reason to suspect it's not good.
If you're gonna continue to 10 lots across the board, I think remember your prior.
Yeah.
Doing that have reduced your gains a bit.
I'm not sure.
You have a couple losers.
Oh yeah, but the end of the year P&L, I've reduced to a single lot.
Okay, I got it.
You see what I mean? But yeah. With mixed lot sizes, if you won big on the big lots and lost big on the little lots, it was distorted. But I took care of that. Somebody else? Yes. The lot size? Well, I wanted to start out small so I could get the kinks out and make sure I enjoyed it, make sure it was a trade that I wanted to continue with. I started increasing it as my confidence grew. My target was 10. And I'll explain here in a few minutes about how I am allocating a certain percentage of my portfolio to this trade. And that will directly result in what size this ultimately becomes. But I'll circle back to that in a few minutes. Anybody else? Okay. The point being, this is a real good year. I'd be remiss if next slide. Next one. Yeah. It's not always a bear market. Okay. So, I'm a year into this. I had good results. Do I want to continue? I've come to the conclusion it's a good trade, but it is highly dependent upon a bull market. The name says bull. What happens when the bears come prowl? I don't know. But what can we do to protect ourselves from that? So a little bit of, I said risk mitigation, let's say risk management, whatever. A couple things I want to think about is, how much, and there's no right answer, this is a personal thing, how much of my capital, my total worth that I'm investing in, do I want to apply to this strategy? Would it be 50%? No. It's too rule-based. You can get, you can lose as much as you make every single trade. So, this would not be a major portion of my portfolio. I think I already talked about, I'm a rule follower. Don't second guess the exits. If it gets down there and hits 250, I know traders. I'm one of them. It took me years to train myself to enjoy taking a loss. Okay? And believe me, I do. And it's a great day when you reach that point. Okay, so when I hit 250, there's no hesitation. I'm out and gone. I don't regret it. Too many times, it's 250. While I'm sitting here thinking it goes to 260, then it's back to 255. No, I think I'll wait a while. No. 250, I'm out. That's why I don't mind using the market order. I want out at any and all cost. I did talk about early profits when the opportunity exists. Like I said, you can never get that 250 because you don't hold the expiration. But if you get over 200 and you still got a lot of time left, you might want to think about just going ahead and shutting it down, take a week or two off, go fishing. Of course, if you know you're in a bear market, just don't trade. Now that does beg the question, right? How do you know you're in a bear market? I don't know. I don't know we're in a bull market right now. I can tell you we've been in a bull market. One of the reasons I like this trade so much is I'm a terrible market caller. I can't pick stocks, I can't read a chart, and I can't predict the market. It took me years to learn that. Is there some way we could say it's time to quit this? And a couple of thoughts come to mind. If I have 3 months of losses, maybe it's time to step aside. I don't know. This goes back to a fixed allocation in your portfolio. Don't start out with 10. Have a string of wins and take those profits and open 11th. You know, take your profits, this is my philosophy, take the profits out of that trade and put it somewhere else. Because when this thing does come apart on you, it's bad enough to lose all 10. It's worse to lose all 10 and all the profits you poured back into it in the last 3 years. So I don't compound the profits. I put them over my cash side, or I put them in another strategy. And everybody on capital discussions talks about a black swan hedge of some sort. I don't know. To me, spent a lot of years paying insurance, never need it. Of course, when it clobbers you, you wish you had it. That's still a big question in my mind. I don't typically hedge. I mean, I've got hedge on by having that long put below the short. So I'm limited. So, but you know, if you're into hedging, especially if people do whole portfolio hedging, then you might want to include this portion of it with that hedge. I don't know. Beyond my pay grade. Okay. I guess that was the end. No. I guess it was the end. Okay. The other comment, I thought there was one more slide. I thought I repeated this slide here that had his course on it. The other thought is to go back and take his course, that next one, I think. Down. Yeah. Is maybe this would teach me what to do when the market starts falling apart. And I'm tempted. I don't like paying people for stuff I can figure out on my own. But this, I don't know. We'll see. Any more questions? Sure. Is the Russell Index? Yeah, John Locke actually mentions in one of his videos using it against stocks or another index, the SPX. I looked at one point of saying, I said, I'm a big SPY trader. And I said, I wonder if I could do this on the SPY. Well, for one thing, it's a lot cheaper, so you don't get quite the premium. But it's kind of hard to know what the rules in this one says. You get 250 credit. You go to the first strikes above delta 10, that gives you 250 credit. And you do a 30 wide. Now, you start trading something else, you've got to modify those rules somehow. Okay, because it's not going to work out. And what I did with, I don't know whether it was the SPX or the SPY, is I modeled the trade in the Russell, and then I took the delta, the short there, and used the same delta in the other index. And use a percentage to determine the spread width. And it just got to be, you know, it turned out the premium wasn't enough to make it worth my trouble. But it highlighted my mind is transferring this to another symbol is not non-trivial. There's some work involved in trying to figure out how to do it. That's what I did. I took the Russell trade, and I said my short was at 14 delta. For the exact same period in time, same point in the market, I went to the SPX, and I says find that 14 delta. And that's the one thing I tried. But then you still got the width. That's got to be a percentage of the difference between parts of the underlying, and I don't know. Hey, it works on the rut. Yeah. And being the index, I didn't realize this real late in the game. I've never done a whole lot with the indexes until the last couple of years, partly because I was afraid of the complexity of dealing with the taxes. And I found out it's actually simpler. And you get like 60% long-term, 40% short-term, even if you hold it for a week. So, you know, I kind of hit myself in the butt for being afraid of that. But yeah, there is tax advantages to doing the index. So once I realized that, I kind of shied away from individual stocks. And the other thing, too, with individual stocks is, and I'm probably outside of my pay grade here, The volatility structure of individual securities is quite a bit different than an index. I don't know how much that would play into how you set this trade up or not. I don't know.
So, two questions that you can kind of answer the same, I think. One question is, how much time do you intend to spend each month now that you've kind of learned to trade in your, you don't have to talk about how much time you put into this learning, because obviously the learning curve.
Yeah.
But like, how much time do you feel like in the steady state you'll spend per month on it? And how robust would you say the trade is to human error? For example, if you forget one day to trade or something.
John Locke said he would look at it a half hour before the close every day. I think you could do that, or pick a time during lunch hour from work. You could, I believe, even test it after the market close. If you're there watching it and you see it hit the 250, that's the most efficient.
I thought you said you put it in order.
You could. I'm not, because I'm on fidelity, but contingent order, you're right. If you put contingent, if you put a contingent order on it, you got nothing to do till a magic day. It's 1 hour a month, theoretically. Now, I admit I do a lot more than that, because what else have I got to do? Right, which I shouldn't be. In fact, I'd probably say there's more danger in overwatching it, unless you're disciplined enough not to overreact. Actually, can you pull up that backtest slide? See, I think it's further up. Yeah, that's it. Yeah, he had a year here. Whoops. 2008. He was down 31%. Okay.
So was he trading the SPY there? Was he rough?
Should have been the SP, the Russell.
Because he's comparing the S&P return.
Oh yeah. You're right. I forgot about that, but I'm pretty certain he was trading the Russell. But I think he just wanted everybody uses the S&P. It looks great in the bull market, but in a bear market, there's going to have to be some modifications. The only back testing I have is just what John Locke did. Back when I first got interested in this and saw this table, I didn't believe it. I wanted to. And I went out and got the free month with option view so I could back test it, and I spent 3 weeks of that frustrated trying to figure out how to do it. So I took the 4th week off and my trial expired. And I come to the conclusion I didn't really care. It was too much work. I used to do a lot of back testing like 20 years ago. I did it in stocks. And I had a program that I could put in buy sell parameters, and it would run and spit out the answer. When I found out option view wouldn't do that, I got just disinterested. Too much work to back test.
Well, in terms of watching and monitoring, you can put in thinkorswim and many other platforms. You can put in alerts.
Sure.
You can say, well, if the rut goes to 1370 or 1352 or whatever number you like, you can have a whole series of alerts. There's a real cost to that.
Yeah.
Wanting to be interrupted at any point.
Yeah.
Any day. Yes, so that's true. There's a real cost.
Yeah.
Well, you can be interrupted with a text message or phone call.
Yeah.
There's all sorts of ways you can do this.
Well, really, the only alert you need is to get out. And if you've got a stop loss in there, it's not taken care of for you.
Right. I mean, that's why I wondered if that would work.
I see no reason why not. I don't do that. But if I had to, I'd feel comfortable doing it. Probably not. Yeah.
I've been doing different full put spreads from this.
Mm-hmm.
Exactly the same thing, but I've been doing it for 6 months with great success, and like I'll leave on vacation and have 4 contracts outstanding, and I put a stop loss in. Now, granted, I haven't ever got one of those called on me. So
Yeah.
I don't know how well it's going to work. But
Just be careful with your stop loss orders and your alerts. Is you can't really put them on the underlying. You have to put it on the spread because that stop loss point changes. You know, so it's and like Fidelity, I can't put a stop loss on anything except the underlying, which is worthless. You know, and the only thing that got from me is a bunch of free trades. I mean, when I wasn't complaining about them, all they did was, well, here, have some free trades, we'll work on it.
Hey, first of all, thank you.
Sure, my pleasure.
I was thinking that if John Locke's other one that you referred to,
The bear?
if he has structured that as doing the same thing on the call side upward, and if he has developed good back-tested rules for that, then you could be looking at an iron condor sort of a thing where you get more premium. And
Good question.
you would win one way or the other.
Good question. No. He in his slide, he says everybody asks, how about making iron condor out of this? No, and now he might switch to a call spread when the market switches, but he discourages putting on an iron condor, and I agree with him 100% because I used to do them. Is that top side will get tested over and over and over and over again, and when you put one on, and you're in the middle of an iron condor, the market goes up, you lose on one side, you gain on the other. The market goes down, it's not, you know.
I wonder what his goal.
It's a bearish butterfly.
It's a bearish butterfly.
I suspect, yeah. And you know, you could say, well, if you're in a bear market, we'll just do the call side of this, use the same rules, but go out up front. But you've got that positive bias of the market that's exactly. So to me, what to do when the markets are not, look at it this way, and I think Don brought this up. I heard the same thing you did on capital discussion about a third of a chance of winning. Is if you put on one of these things, you're going to make money if the market goes up. You're going to make money if the market goes nowhere. You're going to make money if the market goes down, just doesn't go down too far. Okay? That's pretty good odds right there. Okay? Now, I'm not going to put a number on it, but odds are in your favor. And all these little tweaks that he does with the strike price and the widths and the exit rules are just trying to take a little bit further advantage out of the trade. And hopefully, at the second or third year of the next bear market, I can come back and tell you how I survived that. But I'm not going to count on it. Any more questions? Well, thank you.
Thank you very much. We got to get both parts. I thought it was an excellent talk. Absolutely excellent. Thank you very much. And nothing like real experience trading, and we're getting that now from several of our members, and I think that enormously enriches the group. So I'm going to talk. Yeah, that's good. Thank you. And we could go down to. I'm going to talk about backtesting. That's the other side of a lot of what we're doing. You can approach trading in a couple of different ways. You can just go at it. And John Locke himself, when he backtests the strategy, as Tom mentioned a number of times, or mentioned, he does it in option view. I think he does all his backtesting in option view. So for those of you who want to do some back testing, and you should. I mean, that is a point that John Locke made over and over again, and I hear every expert pretty well saying it. You're going to have to back test if you want to build some personal confidence in your trades. Otherwise, you don't know what to do when things seem to be going wrong. You don't know whether it's atypical pattern or whether it's just the kind of thing that happens periodically, and you want to hold through. But I've really focused on doing back testing, and so since this is a nice rule-based strategy, as Tom mentioned, I thought it would be a good one to at least get a start on back testing. And I think the back testing I've done here is not completely adequate, but let's talk about it anyway, because I think there are things that we can learn from it. And the differences, some of the differences in what I did from what John Locke did, I wanted to try and generalize beyond one market. And not right now, but lay the groundwork for that by, instead of talking about fixed width spreads, instead using percentages, using deltas. So I made a gross approximation to the rules of the strategy using what seemed to be similar percentages and deltas. So, well, first of all, just to go over the points that I have here, I'm using end-of-day data. I believe John Locke is also, but I don't know for sure. And I've developed my own automated testing framework. I don't go through these tests one by one, month by month. I do them all in parallel using an R language framework that I've written. And that was just a huge programming effort, but I've done it now, and I didn't think I'd hear from anyone else who would do it. I didn't think anyone else would have the stomach to do it, but somebody has. Ryan has also developed his benchmarking framework, backtesting framework, which is completely unrelated to mine. I mean, we had no collaboration other than a few ideas, but he has developed his own in different language. I did mine in R, and I hope that we can do more backtesting of methods and start to build a base of expertise on them. Ultimately, the thing to do would be if we could get some solid backtesting of a number of these frameworks, we'd be in a tremendous place. In other words, if we could do M3, 60-40-20, a bunch of those, and some of those lessons that we would learn would not really be about the fine-tuning of the rules. Rather, they would be about the risk, the overall risk. And I think that's something that we can start to get a bit of a feeling for looking at these results. Now, there are some minor, so I hope Ryan and I, anybody else who wants to join us, can collaborate and start doing, some back tests and reporting on them. All at the same time, some of them manual, some of them automated, all at the same time as others of us who are, who don't want to do that, whose instincts are fine along other lines, trade systems, and learn equally as much from their instincts and from their experiences. So trying to abstract a little bit from John Locke's rules, which Tom has described, I used a 10% reg T margin. See, if we have a 300 or a 30-point difference between strikes, multiplied by 100, that's 3,000. which would be your theoretical risk and your actual risk. So I just used 10% of that, which would be $300 if applied to this system. Now, this risk calculation, calling that the risk, is completely inaccurate. It's completely wrong, because Regulation T, which is conventional trading that most of you are using, sets a margin equal to 100%, the very worst possible loss you could possibly have. Now, if you want to trade PM or futures, which is span, then you can get much, much lower margins. So when we talk about percentage profits here, you have to remember that you can have percentage profits that are much higher if you want to use span or portfolio margin. But your risk will also be, your exposure would be perhaps higher, but not necessarily. Oh, sorry, Tom.
If you're using 10% of Reg T,
Mm-hmm.
then your P&L would be 10 times higher than what I'm posting for the same trade?
Pardon me? Well, why?
Well, when I calculate my P&L,
Mm-hmm.
I calculate what I earn, return from trade, divide by my max risk, which is 2750, 30-point
Mm-hmm.
spread. And you're using just 10% of that?
This is my risk. This is my max loss exit.
But I mean, well, I say a 30-point spread, and you make $100. What's your percent of return? I'm just trying to get a reference to the way you do it, the way I do it.
I think it's the same, yeah.
Okay.
Not exactly the same, though. So, and instead of a 30-point, but Tom did find some slight discrepancies, so we'll come to those. Instead of a 30-point strike width, I used delta 10 and delta 7. Now, I was discussing this with Tom also, and he says that usually for him it ends up being delta 13 and delta 10 maybe. So I think that is going to account for some of the discrepancies that I got relative to him and relative to John Locke. So in other words, I'm selling a credit spread that is too far out of the money relative to what you could do. Now, there's nothing actually wrong with that. It just means you're going to get a little bit lower return. And that's what I show. So, that's okay. This is not all about figuring out the exact size of the average return. It's really more about risk. And you can choose any value you want for any return you want. So the fact that I chose a further out of the money spread, it's not wrong. It just means that the results will be different. Now, another thing I do in backtesting, and this is unique so far to me, that I haven't heard anyone else doing this, is when you do your backtesting, you have to find a strike that's about the right delta that you want. So let's say if I want to do a delta minus 10 or a delta minus 7, well, I won't be able to get a strike probably that's right there. So I make an approximation. You find a nearby strike, but that distorts your results. So I don't make an approximation. Because all of the functions, all of the calculations are continuous valued functions, you can use, numbers, floating point numbers. So I just choose synthetic, fake strikes, and they plug fine into the equations, and this allows me to perhaps avoids all the games of trying to find the nearest strike, and then worry whether I biased by choosing a lower strike or a higher strike. And
But it's not realistic in real life.
I think it is more representative of the underlying distribution, of the underlying characteristics of the market at the price of yes not being exactly achievable. But you have to decide if you're going to do a simulation, what's important and what isn't. Okay, so also I report by calendar months, not by contract months. In other words, I look at each day, although I place the trade properly on the however many days it is before expiry. But then when I add up, I want everything to market. I don't want anything that's paper profits or anything like. Well, I want everything to be paper profits. I don't want anything to be realized profits only. I do everything mark to market, which I believe again is the correct way to do things. And you hear some people anecdotally say, "Oh well, I finally rolled over and that caused me a loss of $50,000 in my account or whatever." That shouldn't be the case. You should be marking your account to market at all times. That's the approach I take anyway. If you want to go by, by nominal profits, realized profits only, fine. Okay, so let's go to the next one, please. And then we have the question of return. Well, I already got into this. What return do we want to talk about? Here, I think, and I took this because I know people are using it. I know you're using it, or people generally, I gather, use return on margin. But really, that is not a correct gauge because your risk is not the same if you're selling a spread that is way out of the money as if you're selling a spread that is at the money. I think you'll agree with me on that. Yet, allegedly it is, according to this measure, because we only look at the difference between the strikes. So I think it's completely wrong, but nonetheless, just for convention's sake, I went on this definition that everybody's using, which is return on margin, and in particular on regulation T margin. Now, I only yes, go ahead.
I think it's fruit fly, but a lot of the trades that come out of especially fruit, they have what they call planned capital.
Yeah.
If you were in a trade that you set up planned capital for, would you use that as a basis of your return?
Yeah. Okay. But you can do that, but then what does that mean? What is your planned capital? I mean, is it what?
Say the fruit fly is that. It's a planned capital. When you put a fruit fly on, you're supposed to set $4,000 aside to cover entering the position and possible future adjustments.
Yeah.
I intend to use the full $4,000 because that's money you got set aside.
But what's the margin in that trade?
I don't know the margin.
Yes, it is true. A lot of people are talking about planned cap. Oh, well, I think what they mean by that is that they're putting on less risk than they initially could.
Exactly.
But they're saying, I'll add more, and they do that a lot. So yes, that is another important concept. That refers to your preparedness to add additional capital to the trade.
One way you can be prepared to do it if you've got it sitting over there waiting. So it's in effect tied up.
That's another aspect. Anyway, what we're talking here about is how margin differs from risk, and these three different margins. And also, in Tom's case, he's adding additionally how it may differ from the capital that you're prepared to add to the trade in the future as well. So it's really a very complex topic. Does anyone have any thoughts on that? Yes, Michael.
I would appreciate it if in another meeting later on, take that slide, unpack it,
Yeah, I agree with you, and we will. To me, the only rational measure of margin is span margin, which is used in future markets. And I would only, that's what I plan to continue to trade when I trade futures markets, because otherwise you're making all sorts of ridiculous additions of risks that aren't really additive when you have multiple legs or when you have multiple instruments being traded in parallel and so forth. Anyway, that's part of that future discussion we have to have. We could go on to the next one, please. The other concept is, now, I don't have to really go into this, I believe, because Tom did an excellent job on, he explained Mach's loss. But I think the term is extremely confusing to me, maybe not to you. What is Mach's loss? Is anyone confused? No? You're not, but you're an expert trader. How about, what would somebody who's not an experienced trader? Mach's loss, what they basically mean by that is a stop. That's their stop value. It doesn't mean that you can't have a larger loss than that. It just means that you hope to get out when it gets that far. I think that's just an incredibly optimistic or euphemistic name for a stop loss, but whatever. The problem that comes in here is as we trade further and further away from the money, I think we're really using the logic. It's never going to get down there. Or if it does, it's going to go slowly enough that we can get out at our max loss. And so far, mostly you can. But you have to realize that you may not always be able to. And what we're doing here with a lot of these trades, and I see it more and more, is people are going further and further out of the money and selling wider and wider spreads. And it's all based, really, on this rationale that we're never going to get down there so fast that it'll be a problem. We'll always just step down nicely, and I'll just get out when it hits. But that's the whole basis of the profitability. Not the whole basis, a large part of the basis of the profitability of these trades. So a question is, if the market is pricing these out-of-the-money strikes so expensively in terms of implied volatility, maybe it has its reasons for it. And maybe we won't always be able to just reap that in by saying, oh, I'll be able to get out in time, and no problem. So I'm saying that as a caution to all of this. In other words, this all sounds too good to be true. Maybe it is. I'm not saying it is. I just say be careful. And certainly we know there have been times where we've had gaps overnight. We've had trading halts. We've had closings. And I mean, I myself had major problems. I think it was October 2008. That was actually managed money at that time. I haven't traded much. I haven't had many people manage money for me, but I've had a few. And when the I think it was October, I forget the exact date, and when we had that huge crash, the brokers' systems break down. They get margin calls all over the place. They lose track of the guy who was trading for me had offset the risk overnight as the market crashed. But the company, he did that in a different instrument, and the company lost track of that, and they just liquidated everything. And the way they liquidate is they don't necessarily see your spreads. They don't liquidate on a spreads basis. they go and find the shorts and go for them first. And by the time they get around to the longs, or you do, there may be no representation, no relationship to the value they got. And so you've got to really be leery and careful of strategies that rely on far out of the money trades. But as Tom said, there's some protection for this if you relate to your account size. If you have a large account and you're trading only a small portion on this, then it's safer. Wait till we look at some of the drawdowns. If you're going to have drawdowns of 30%, 40%, I think we saw in some of those in 2008, you can't afford to be trading 100% of an account on that unless you're prepared to throw away the account. It should only be a small percentage of the account, or it should be in an account that's a small percentage of your net worth. And diversification is a large part of that also. There's the question whether large losses are ever acceptable because of the difficulty of regaining money. I think maybe the answer is no, but anyway, I'm just saying be cautious about these systems. I'll look at the numbers in a second, but since we're here, let's talk about this just for a minute. You can do manual or automated backtesting. Thinkorswim, you can do some, but it's limited. OptionView or OptionNet Explorer will cost you $100 to $200 a month. So if you can't afford that amount of money, know-how, then they're not for you. Well, actually, OptionNet Explorer is down to dirt cheap now because of the crash of the British pound. So it's a real bargain right now, and there's special offers. There was a system called Quanti Carlo, which is no longer on the market. So you can always do it manually, or you can, if you're really, really good at programming, maybe you can program it. But there's not any frameworks. I would say for the average person, start doing it manually with the aid of Thinkorswim. And after you've done a bit of that, if you find it frustrating because of the technical limitations, look at OptionNet Explorer, to be perfectly honest, because it's half the price. But theoretically, OptionView. There's a reason for using OptionView. If you're trading John Locke systems, then all of his rules are based on OptionView. And it turns out that all the deltas are different, needless to say, in OptionNet Explorer. So John Locke has very, very elaborate systems beyond the one we're talking about here today. And it's all rules. And at one point he included Thinkorswim. He no longer does. It's OptionView, OptionView, OptionView. If you want to go that way. And if you need help finding those offers, we can help with that. I can help you find them.
Speak to your data source. Where you get all these quotes.
Yeah, I think I have a slide on that. Let me see if I do or not. Yeah, if you go 2 down, where to get data. It's built in Thinkorswim, OptionView, or OptionNet Explorer. To purchase your own, here are some sources. CSI, iVolatility. And I just found this one, deltaneutral.com. I'll certainly give these slides, to anyone, so don't bother. Yes. Yeah, yes. Sorry. Say again, sorry? Technical analysis. Yes, I have a number of moving averages and so forth coded up, and other indicators. I myself am not a great believer in technical analysis. However, there certainly are occasions where you can at least use certain indicators. They're in even these platforms, I believe, Thinkorswim. A lot of these indicators, MACD, Bollinger Bands, are in most of these platforms. But if you're coding yourself, you can, there's routines available fairly readily for those basic. Do you have any comments on that, Ryan?
I got all my data from my volatility.
Mm-hmm.
And I think the price recently went up.
Yeah, but how about coding?
Oh, I'm using C# with SQL backend. I'm using R.
Yeah.
Which is an R database, right?
Yeah. Now, you actually can get settlement data from some exchanges, and I've actually done this, but I don't believe, that was a gargantuan effort to decode their huge, elaborate XML coding structures that they use for their settlement data, which is designed for clearing firms. But you can get free data that way, if, you want to put that amount of effort into it. Could we go back one round? And in terms of learning venues, these are capital discussions. Yeah, but those are some of the ones that we recommend. They get a little bit of back testing, certainly. Let me just see. Let's go to the data. If you could, if you would, please, Ryan. That's a separate PDF. Yeah. So there's some interesting points here. I would say let's look at some of the later years, if we can. Right. Thank you. First of all, in this first column, can you lock? Oh, I don't know. It's impossible, I know. Yeah, if you could, that'd be great. Oh, it doesn't matter if not. Yeah, it's. If you freeze panes. But I don't know if it's going to work. Maybe it will. It gives an idea. Oh, perfect. Perfect. And the first column is a return if you take no exit at all. Really, that's the base condition, I think. The base case is before you start testing losses, what happens if you don't take any exit at all? Because maybe that'll help us later when we decide how large or where to make our exit. And what I found here, and I had it in dollars, I'm not showing dollars, I'm just showing the return as a percent. All of these values are percentage returns and also drawdowns as a percent of that same amount and of your margin, rather. And I found that you earn twice as much money if you take no exit whatsoever. No. Yeah, the problem is that, but yeah, we have to look at the drawdown. Look at, this is what, you spotted this, right, this line here? He went right to the heart of the whole point, which is why do we do the stop loss? If you look at these values here, the no exit is almost always better. Almost always better. Not always, but most of the time. But the price for that is back in 2008. You have a 85% drawdown if you don't take the stop, and you only have a 34% drawdown if you take it. So just realize that whenever you take a stop loss, there's a price to be paid for it. It's going to hurt your return. And the question is, are you willing to pay that much of a price? Because it's half the return. I'm fairly confident. Yes, Michael?
In 2008, there's an 85% drawdown.
Mm-hmm.
Does that mean that in 2009 you started with $15 instead of $100 and you got a 25% drawdown?
Well, this was the drawdown.
Well, what was the asset base for the following year?
Well, a drawdown is not. It depends whether you took it or not. You see, if you stayed in the market, then theoretically you would have come back. That's the basis of it, and you would only have been down 60%.
Are you assuming you're starting with $10,000 or are you planning to go $1,000 to $20,000?
These are separate. They're not. They're independent. Because it just gets too complicated if you try and make it all serial. But yeah, you would be down to 15. If your account was worth $100,000, it would be worth only $15,000 at the lowest point. Now it's up to you what to do at that point. I mean, this assumes that you have infinite, prepared to shovel in additional capital.
That's not exactly the world.
Right. So it's totally unrealistic. That's why, and you notice John Locke doesn't show drawdowns. And I'm sure that he takes account of those situations in other ways. But anyway, now I get, my results are only 10% average return. And Tom and I were discussing that, and we believe it's because I'm a little further out of the money than I should be, or according to his system. So, in other words, I'm going with a 10 and a 7. See, I'm not using his rules. I'm using a reinterpretation of his rules. So, I think that if and I'll retest it. It's quite trivial to do. I just, didn't have a chance to do it. I didn't know until I spoke to Tom that would be one likely source of the discrepancy. And also, I would say another thing to remember is that these returns would be higher if you're on portfolio margin or on span margin, which I would be. They'd be very, very much higher. Say that again, sir?
You've got more data in your back test.
Mm-hmm. Yeah, and you can also argue that exactly. You can argue that the market may have changed, and in fact, I think, I think the market probably has changed. And it certainly changed if we go back all the way to, what was it, 1987 or whatever was the crash? I mean, up to 1987, or if that was it, the volatility structure, the skew structure of the market was totally different. And I've heard people say that it has changed in recent years also, that in the last 5 years or so, it has changed. So, you know, you could take these, put more weight and get different numbers on the results.
Say that the way your backtesting is excellent. I mean, every trade uses the same amount of capital. They're all equally weighted in your test results, and every year you start off with the same amount of capital, and that's how you're measuring your annual results. So that's exactly what you want with the backtest. And you're taking a trade every month as well.
Yeah, I mean, actually, I got some of that from Ryan. Originally, I was doing it a different way, and you know, if you're putting dollars here, you really fool yourself a lot of the times because everything's changing underneath. So I switched to just using return. By the way, I had about another zillion columns on here, but it's just, you know, unreadable. And I also tried like higher loss, like 20% and 30%. They didn't seem to improve. It didn't make much difference.
You mentioned you felt like the term structure of volatility changed. What, can you elaborate on that?
Yeah, until 1987, there was no volatility smile. Is that correct? Yeah. Pardon me?
There was no skew prior to.
No skew. Yeah, no skew.
So how was that?
This whole thing wouldn't work at all because all of these systems are based on selling overpriced, below the money volatility, low strike volatility. I mean, there's a reason. If you look at all of these systems, they always position themselves above the market, or I'm sorry, below the market, so that they give themselves some room.
So are we not getting the same premium that we would have 10 years ago, or?
Well, now that was way back then when they had that huge crash. Currently, I couldn't tell you the details. We'd have to study it. We'll have to look at that. But as to more recent changes, but relative to 1987, there's, you know, we now have this huge excess of premium relative to then, but below on lower strikes. So that's why you want to always sell lower strikes, or more exactly, strikes that are have higher volatility. The lower, no, just lower. Well, if you look at the skew curve, just the lower you go, the better in terms of the higher volatility, higher the implied volatility. And on the upside, this is a whole great topic, but you have a smile in indexes. You do not have a smile, I believe. Am I getting that right, or the other way around? And in individual stocks. John Locke. Does anyone have any other comments on this? Oh, sorry, Dave.
Can you briefly touch on a couple things? I noticed a new interesting call for pros years. One is 2002.
Yeah.
Another one is like 1995. 95, I'm looking at your drawdown, no exit, 28%, 95. And your drawdown with the 10% loss is 37. You're actually on a larger drawdown.
Yeah.
So in essence, your stop loss actually major drawdown works.
Yeah.
So can you talk about that a little bit, and also like, you know, basically it's like, why would some years that 10% loss actually do harm? But it kind of protects you in the really, really bad years. But there are some unusual years like that, and I think one later on was maybe 2000.
Well, it just depends. I think it just depends on where they fall. And in other words, if you have a stop loss and the market comes down and hits your stop loss and comes right back up again, it's not a great deal.
So you're getting whammied over and over again.
Yeah.
You're right at your stop loss. Right about that point, and you would have been better not having the stop loss.
Yeah.
Look at the return difference, 42 versus 94. That's pretty huge.
Oh yeah. Well,
I have to wonder if you're using money management. You know, are you? I don't know.
no, I agree with you. As a matter of fact, I'm glad you raised that point.
Done deal.
And we're doing everything for this one particular.
No, I think you're going to have. I think what you're saying is in comments, 10% tight, but I think you're going to have a similar effect no matter what stock you pick, aren't you? Stop loss will guarantee you. Yeah. So you may have a year where you're going to get a long string of losses because of that stop loss. And that's when you take max loss. But look at 2002. Exact opposite happened. No, I'm sorry. That's the wrong time. It would be interesting to see what, like a delta column of what the stop loss actually did. Saved you every year. Like, you just sort of think about that in percentage terms. If you just let it ride versus, you know, not letting it ride, it's doing something.
Well, that's basically what I have here, where this is no stop loss in these.
No, I'm saying that the difference in the two drawdown.
Oh.
The two drawdown columns have a different column.
Oh.
Those two to see what that actually did for you.
See, it's doing so little for you that I'm wondering if it wouldn't be better to take a different approach, and instead of using a spread, a vertical spread, use a hedge. In other words, buy VIX, buy puts, buy VIX, buy the VIX in some way. And I think there could be ways of doing that would allow you to have double the profit. I mean, especially since some people are now saying that there are hedges that are free or that are almost free. Now that is questionable. I don't necessarily accept that, but I mean, one way to do it is who's that? You can just trade the VIX with an oscillator. Who's doing that? What's the name of the guy that's doing it? 60-40-20. Andrew Faldy is doing that. He's constantly in the market, long or short the VIX, just as a hedge, so that he doesn't lose if the market suddenly crashes. And I think, that could be, yes?
Well, we go back to tasty trade, and the rule is take your profits at 50%. Is there a way to build a column that instead of percent return with no exit, percent return at 50% of the max?
Well, taking profits, profit targets, and I don't know whether, I think most people think that taking profits doesn't work. But apart from tasty trade, but it's testable. I mean, it's definitely testable. I mean, does anyone have any opinion on taking profit targets? I mean, at a certain point you want to take them, certainly, but 50% is very, very early. If you don't let your profits run, most people say you're going to have major problems.
Well, I think it might depend on what you had. If that's one thing. If you're trading butterflies, you probably
Yeah, well, of course we have down.
I prefer to take only 20% profit or 30% profit.
Yeah, 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 sure. I think we're almost, let me see what I had on the other slide, broader issues. Well, I think we'll leave the other topics and instead ask for any other comments. Yes.
My email address is on my front slide. Don't hesitate to drop me line if that's it.
Well, that's very nice of you.
I meant to say that before, but I
Tom at THOMARK.com. Are you going to give us your slides, by the way?
yeah. All right.
And then how about the Excel tool? Do you want to post that as well?
Sure.
Really?
I'll put it together.
Yeah, we'll let Tom, edit them a little bit, post-edit them or whatever a little bit. And can we put them on capital discussions as well?
If you want to, sure.
They like attachments to the, I mean, as an attachment to the record of the of the video. Oh yeah, no rush at all. Other comments? Yes, sir. Regarding
getting the data
Mm-hmm.
for backtesting, when there is a thinker frame or optional, right? We should be a member of, I should be an account holder in all the companies or?
Well, what type of data do you want in your case? Options or stocks or end of day?
Probably like 1 week.
Pardon me?
1 hour, for every 1 hour cycle.
Oh, that's really expensive. But there's one really cheap source that I didn't put on there, which is Macmillan's company. You can just pay $25 a month and download all history of all, well, no, unfortunately he cut it back, but past couple of years now, 2 years of option, every stock and every future too. And if you go to, is it Ernest Macmillan or Strategy Zone, I think, or his book was Options as a Strategic Investment, and that's the cheapest source of data by far if you're going to go for paid data. But it's rough data. It's a little bit rough. You better be good at writing data cleaning routines, which I've done. I mean, the current data would be okay, but I mean, it's a tiny fraction of a % of the cost of all the other data sources. But it's not. If you want to spend more, what instruments do you want to test? Oh, intraday? Well, intraday is extremely expensive. Brian, do you have any?
I didn't purchase any of that.
I think you better be careful. It's usually better to see what you can do with end of day data because it's so much more affordable before you go to intraday. Oh, you can go to. I think the thing to do is use. Does Thinkorswim think back? Does it have?
Limited structure. They don't go very far out.
Also, when you're back, I don't know, maybe.
It's not think back is in the day, but you can actually, there's a button there,
On demand.
On demand is there.
Gives you actual, if you want to go back to January 1st, January 12th,
Mm-hmm.
everything is happening for that day, whatever time you want to start.
It doesn't go back very far away from our money though.
Well,
I think you only get a limited number of years.
Yeah.
Yeah, but you can look at on demand from Thinkorswim, and it is an option view also. I know they do have. You can go back, I think, 8 times a day, or maybe every 10 minutes, or some such. The other place you could go if you really want is TradeStation, but they don't. I don't think they have options historical data. But those are some sources. email me if anyone has trouble getting data or whatever.
Don, are you going to run the backtest, the different rules?
Yeah, I'll try. I'll give it a try, and I'll hold off. Yeah, I will try it and see. We shouldn't rule out the possibility that there would still be a difference, and that it might be just other methodological. Number of months. Wins and losses. And each being a month in this case with this strategy. He has that. John Locke has that in his. Well, I have it. But you didn't put it up, what I'm saying. No, I didn't. But if you want some of that, oh, you've got it. Okay, yeah. Okay, I'll do that. Yeah, I can do that. I think it's worth spending a little bit more time seeing what we can get out of this. I'll work on that.
You can interpolate any day in time, any price on that particular day. Would it be beneficial to enter a new trade every day for your backtest?
It is, but I mean that's not his strategy, right?
Sure, but I'm saying like if you want to test that trade, like just test a bird eye, and you can get 300 different trades in a year. 350 trades a year.
It's a possibility. I know you've done some of that. We can, I can look at that. I want to keep it simple in stages, and we'll do it stage by stage. Well, thank you Matt, were there any no comments? Okay. So thank you very much for coming. Let's go eat a little bit. Oh, thank you very much. Let's go eat. Those who can join.